What's hot today? Makes it sound a bit sensational, which I know you're not. But to tell me about.
No, I get it. So, okay, I think our investments fall into three buckets right now, right? One will be your value add workforce multifamily, and that falls into kind of two sub buckets. One will be the demand market, like a Phoenix, where you're buying at very low cap rates, sub 3.5 in many cases. Right. But there is a business plan where you're going to get, rent increases, and the ability to create value exists such that, buying a 3 or 3.5 cap deal can make sense. Again, in so much as you believe there's downside protection, your coverage ratio makes sense, and the business plan is achievable. We want to look at the comps and say, we know how we're going to renovate this property. We know what it's going to look like upon completion. And if at the end of the day, it's going to look better than other properties who are already getting our pro forma rents, that makes us believe that the business plan is achievable. And in a vacuum, and I feel like I've been using that phrase a ton recently, but in a vacuum, right? There's just been a ton of capital, and this isn't something the listeners don't know, that's pumped into the economy. And even if it gets into the hands of the people who need it the most, it eventually trickles into the hands of the wealthy. And that's what's led to all this asset level inflation, right? And so even though we've been very concerned about the downside as we've made investments over the last 5 years or so, we do have to acknowledge that assets should continue to appreciate. If that's another 2, 3, 5 years, it's hard for me to say. Depending on who you speak to, you can hear a wide range of thoughts there. But generally speaking, if a deal has strong downside protection, the business plan is achievable, we likely want to own that asset. We want to be asset owners in the current market, right? And so we look at some of that, workforce value add and demand markets that has a ton of the value creation story. And then we also like the smaller secondary stable tertiary market, maybe where you're buying a 150 unit multifamily class B, and you're buying it at north of a 5 cap, right? So your margin for error is a little bit higher. You don't need to get $250 rent bumps in order for the deal to make sense. It cash flows, better in the early years. We like those types of deals as well in the multi space. Again, Class B is interesting because regardless of the economy type, someone's in Class B, right? C moved to B in a good economy, A moved to B in a bad economy. There's always somebody there. Again, minimizing variables. That's an area we like. We've historically and will continue to do a lot of senior housing. Right. It's mostly been assisted living and memory care. And, for obvious reasons, we haven't acquired any properties over, I think, the last 14 to 16 months, something like that, right? But if you asked me 6 months ago, I would have told you, and this is before the Delta variant became a real issue in that space, I would have said, we're looking at an acquisition-rich environment over the next 12 to 18 months. It's a very fragmented asset class, tons of mom and pop owners who have their entire retirements tied up in 1 or 2 assets. And even if they didn't have COVID cases or deaths, they had to deal with the rising labor costs, right? And that put a lot of pressure on the mom and pop that an institutional manager like the one that we acquire assets with, didn't experience to the same degree, right? Of course, the portfolio took an occupancy hit during COVID, but it's bounced back, pretty quickly, and we're kind of comfortable where things are. And there's still some room to get back to pre-COVID levels, but we're well ahead by, I think, about 5 percentage points on occupancy about over the rest of the market, right? And so we're expecting to see opportunities there. It's an asset class that most operators are on the ground up side in an effort to deal with the supply-demand imbalance as baby boomers head into those facilities. The group we work with focuses exclusively on acquisitions. There's a limited universe of buyers in that space. And so we tend to find really interesting high 7, 8, 9 cap rate acquisitions that will cash flow in the high single, low double digits right out of the gate. And then also have some upside as part of this larger portfolio we're building. And then the last area that we're deploying capital in right now is a single family rental space. And it's relatively new for us. We just started this year. It's an asset class that we've been talking about for years. The challenge is, as an individual group, it's a really hard thing to do, right? And anyone who's ever owned a rental property knows you go out and you buy it, it's a ton of work, what have you. It's really important to build scale in whatever given market. And so we found an operating partner that kind of fits perfectly into that strategy. And we just love the big picture stats about single family rentals. And I'll throw some of them at you because they were new to me when I first learned them. I guess anything's new to you when you first learn it, but it wasn't that long ago that I learned these stats, right? But I think it's like 53% of the rental stock in the United States is single family housing, with the remaining 47 being apartment buildings. And that's never what I thought, right? I would have assumed that there were way more apartment buildings, right? But despite that, and pre-COVID, only about 2% of single family homes were owned by institutional private equity, right? Whereas if you go back to multifamily, it's about 50% institutionally owned. And then if you think back, and this is before my time as a professional, but the early 90s, multifamily was not seen as an institutional, quote unquote, asset class, right? And it got there, over time. And our expectation is the same thing is going to happen in the single family rental space, right? And so our strategy is really to buy up very similar types as we do on the multi side. So, workforce, value add. We come in, we typically spend $15,000 to $20,000 renovating any given home. And the rents post renovation are typically not exceeding $1,400, $1,500 a month, right? They're very affordable to the demographic that lives in that local market. And then what we'll do, and we're in 2 cities now, about to get into our 3rd city, is build up a portfolio of maybe 1,000 to 2,000 assets, stabilize it across 4 or 5 markets, and then we'll look to sell it to an institution and get that portfolio premium as well. Because what we expect to happen, particularly over the next 3, 5, 7 years, is that what was 1% institutional capital pre-COVID, which is about 2.5% to 3% the last time I looked at it, 5, 10, 15, 20%, in the next 5 to 7 years. And the challenge is to go in. You can't buy, if you're going to deploy $200 million in the space, you can't go out and just buy $200,000 homes one after another. Right. It's just not a efficient way to deploy capital. And so having a portfolio of 1,000 stabilized assets is a very attractive exit to an institution. And so it's newer in our portfolio of asset classes we invest in, but one that we are very, very bullish on.